Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. In this video, we are going to discuss a simple portfolio that was able to outperform the benchmark index by a significant margin in the past. I will also share the names of the 20 stocks in this portfolio that you can keep on your watch list for 2023. But first, a short story on how the strategy behind this portfolio came into being. Can you explain your stock selection theory but without using mathematics? Yes, you heard that right. I want you to try explaining your stock selection theory to a fellow investor without using mathematics. Difficult, isn't it? Well, a gentleman who answered to the name of James Rea had figured this out. James came up with what I believe was a wonderful analogy to explain his stock picking without using mathematics. James compared his process of stock picking with that of selecting a milk cow or a milk buffalo. Yes, a cow or a buffalo. James argued the milk that the cow will provide over its useful life is like the earnings of a company. The growth in the cow's milk giving capacity is nothing but the growth in earnings. The cheese that will be made from the cow's milk can be thought of as dividends. And last but not the least, the price at which the cow will be sold after it stops giving milk can be considered as the liquidation value of the company. Now, the higher the price a cow buyer pays than the liquidation value of the cow, the higher is going to be his risk. Likewise, the more an investor pays over and above the liquidation value of the company, the greater is going to be his risk. So, what do you think of the analogy? Isn't it bang on the mark given that it uses no mathematics at all? Now, I don't know about you, but this analogy left Benjamin Graham highly impressed when it was presented to him. Yes, the same Benjamin Graham who is known as the father of value investing and the guru to Warren Buffett, arguably the world's greatest investor. Interestingly, James Rea had never heard of Ben Graham until he read one of Ben Graham's interviews in the 1970s. James found similarities in the way both he and Ben Graham approached stock picking. Therefore, he decided to forward his research to Ben Graham. A couple of months later, Rea received a call from Ben Graham himself and suggested that they should meet. It was in this meeting that James presented his milk cow analogy and made a good impression on Graham. This meeting also laid the foundation of a 3-year working relationship which led to both Rea and Graham launching an investment fund. Now, this investment fund was to be managed using a strategy that both Graham and Rea had jointly developed. The strategy was based on 10 stock criteria or 10 rules, and both of them had thoroughly backtested it, going back as much as 50 years, that is between 1925 and 1975. In other words, they went back in time to the year 1925 and started applying this strategy on stocks over the next 50 years. Well, the results left them pleasantly surprised. First, they realized that using 10 rules or 10 criteria for stock selection was too cumbersome. There were very few stocks that cleared all the 10 filters. Therefore, they had to include stocks in the portfolio even if they did not clear all the 10 filters. They also realized that not all of these 10 rules or filters were of equal importance. There were some that were more important than the others. Now, after testing each of these 10 filters or 10 criteria individually over a 50-year period from 1925 to 1975, here's what the two of them concluded. Buying stocks that are attractively valued, that is low PE stocks or high dividend yield stocks, or even stocks trading at a discount to their current assets minus all liabilities, works out very well over the long term. Each of these approaches ended up performing twice as better as the benchmark index over 50 long years. Put differently, if the US benchmark managed to earn 7% per annum between 1925 and 1975, Each of these approaches earned a minimum 14% per annum during the same period. This is huge in my view. To outperform the benchmark index by such a wide margin, and that too over such a long-term period, was certainly a commendable performance. In fact, so impressed were both Graham and Ria with these results that they dropped most of the 10 filters that they had zeroed in on while devising their strategy. They came to the conclusion that in order to put together a market-beating portfolio, they don't need 10 rules or 10 filters. Only 3 rules are sufficient. Yes, you heard that right. In order to put together a market-beating portfolio, you don't need a lot of factors. You need to keep it simple and use only 3 parameters. Now, what exactly are these 3 parameters? Well, they are on your screens right now. These parameters, as per Graham and John Ria, are earnings yield of at least twice the AAA bond yield, dividend yield of at least 2/3 of the AAA bond yield, and debt to equity ratio of less than 1. Now let me spend a few seconds explaining each of these. The inverse of the P multiple or the P ratio is the earnings yield. Therefore, what the first condition means is that if the AAA bond yield is say 6%, the inverse of that is a P ratio of around 17x, and half of 17x is the maximum P ratio that you should pay for a stock as per Graham and Ria. This translates into a PE of 8.5 times in this example. The second parameter is a dividend yield that's 2/3 of the AAA bond yield. Now this is straightforward. If the AAA bond yield is again 6%, then the dividend yield of the stock should not be less than 4%. It should be 4% or more. And last but not the least, the company should have at least a decent balance sheet. This means that its debt to equity ratio should not be more than 1 times. Its debt should not exceed its equity. That's it. These are the 3 parameters. Graham and Ria were of the view that if you create a portfolio of stocks based on these parameters, there is a very strong chance your portfolio will outperform the market over a 3 to 5 year period. Now, unfortunately, Graham passed away a few months later after the fund was launched, and therefore we have very little information about what happened to the fund after he passed away. However, what we can certainly do is adapt these 3 parameters to the Indian stock market and see whether they deliver what Graham and Ria promised. It will be interesting to see how a portfolio created using these 3 simple rules performs in the rough and tumble of the Indian stock market. Well, this is precisely what I have done. I have backtested a portfolio of 20 stocks using the filters highlighted by Graham and Ria and evaluated its performance vis-a-vis the BSE Sensex. Here's how the performance stacks up against the BSE Sensex. A CAGR of 18% in Indian stocks with the strategy outlined by Graham and Ria is not bad at all in my view, especially when you consider that the Sensex has earned 12% CAGR during the same period. On a cumulative basis, that's like multiplying your money by 5.2 times versus 3.2 times returns achieved by the Sensex. Also, the Graham and Ria portfolio has not outperformed the Sensex in all the years. There have been years where Sensex has done better than our portfolio. However, net, our portfolio has galloped ahead by a significant margin. I am sure you're keen to find out my filters for this portfolio and other details like portfolio weightage, when to sell, when to buy, etc. Well, the filters are extremely simple. They are a carbon copy of the 3 rules that Graham and Ria devised. All I have done is Indianized them slightly, that is, adapted them to the Indian conditions. That's it. I have done nothing else. However, before we look at the filters, here are other important information about the portfolio. So what I did was put together a list of top 500 companies by market cap back on 31st December 2012. Then I made each one of them pass through the 3 Graham and Ria filters. The stocks that cleared all the 3 filters were then arranged in descending order of the latest debt to equity ratio. that is, company with the lowest debt was ranked the highest, and so on. This way, I shortlisted the top 20 stocks from this second list, and this became my portfolio for the year. Now, as far as the characteristics of the portfolio is concerned, the 20 stock portfolio is an equal weighted portfolio with roughly 5% invested in each stock, and holding period is 1 year, which means that I'll sell this portfolio on December 31st, 2013, that is full 1 year after I created this portfolio, and invest the proceeds in a new portfolio created using the same rules. This portfolio will also be held for 1 year, and so on. So this continued all the way till December 2022, and the results that you saw earlier, where this portfolio outperformed the Sensex by a considerable margin, were driven by this portfolio strategy I just discussed. Now, on to the main thing. What are the three filters that I used for Indian stocks that were based on the original Graham-Rhea study? Well, here they are. Now, Graham and Rhea wanted a yield that's twice the AAA bond yield. Well, for Indian stocks, I have considered a PE of between 5x and 15x. I think taking into account the Indian markets, a PE ratio of between 5x and 15x is akin to investing in a value stock with a sufficient margin of safety. Therefore, this satisfies the first Graham and Rhea filter. In terms of dividend yield, Graham and Rhea recommended a dividend yield of 2/3 the AAA bond yield, whereas for our Indian portfolio, we are considering a dividend yield of 2%, which I think is not very high and neither very low. Last but not the least, Graham and Rhea suggested a debt to equity ratio of less than 1, and for Indian stocks also, I have considered the same ratio of debt being as less than the equity as possible and never exceeding it. So that's it. These are the three simple filters that I used while creating the portfolio that I just discussed, and which resulted in a CAGR of 18% versus the 12% returns given by the Sensex. I'm sure you're wondering how come this portfolio has done so well when even the smartest fund managers find it difficult to achieve this kind of alpha over 10 long years. What's so great about this strategy? After all, it is very simple and anybody can follow it. Well, I think it is this very simplicity that prevents a lot of investors from adopting this strategy. They believe that in order to do well in investing, they need to have a detailed understanding of different industries, different companies, track their quarterly results, attend their con calls, prepare detailed spreadsheets, etc. I'm not saying this approach does not work. If you put in the hard work, it can certainly work. However, if your goal is to beat the broader market by a few percentage points every year by using simple techniques and principles, then the Graham-Rhea strategy has certainly proven to be a top contender. In fact, even Ben Graham in the later part of his career had grown disillusioned with detailed analysis of companies. Here's what he said in one of his interviews. I have lost most of the interest I had in the details of security analysis, which I devoted myself to so strenuously for many years. I feel that they are relatively unimportant, which in a sense has put me opposed to developments in the whole profession. I think we can do it successfully with a few techniques and simple principles. So here's the man who practically invented the whole discipline of security analysis, arguing that when it comes to stocks, simple more often than not beats complex. And as my study just showed, that's indeed the case in India as well. Now to the most important part of this session. What is the portfolio of 20 stocks that the Graham-Rhea strategy is recommending for 2023? Well, without any further ado, here's the list of the 20 stocks that I have shortlisted using the three simple filters we discussed earlier. There are some famous names in there: Petronet LNG, Sun TV, Nalco, and going all the way down to GHCL and PCBL Limited. Worth reminding that each of these 20 stocks has been shortlisted based on the Graham-Rhea strategy we discussed earlier. There's nothing more to these names. Now, is this portfolio guaranteed to outperform in 2023? Well, nobody can guarantee that. But if the track record of this portfolio is any indication, there's a strong chance of a good performance over the next 3 to 5 years. Therefore, this is a good list to keep on your watch list for 2023. This brings me to the end of this session. Please do not forget to share your honest feedback with us. I'll see you again next time. Goodbye and happy investing.